I'm Stephen Brown, and this is Weekend Connection. Many people today are not comfortable organizing their financial affairs, or they just don't know where to begin. But as people approach their strategic financial planning, they need to keep in mind some ways to maximize their retirement savings. In the short term, as we rapidly approach the end of the year, there are some tax tips to keep in mind as well. So, let's get connected. My guest today is Angela Sloan, CEO and founder of Sloan Financial Group, located just across the border from us in South Carolina. Angela is well known for the complimentary educational programs she hosts throughout the Carolinas. Her commitment to helping families organize their financial affairs has won her numerous accomplishments. She's been featured in several financial publications and has made guest appearances on national financial-related radio and TV broadcasts. Angela, welcome to Weekend Connection today on BBN.
Thank you, Steve. It's good to be here.
Angela, many people today, and I understand most women, are not comfortable organizing their financial affairs, or they just don't know where to begin. With so many financial advisors and planners out there today, should they just use a dartboard to pick one out? What are the important questions they should be asking?
Well, first of all, the number of years experience. And as women, we can interview these people. We have a very good gut intuition, and I think you need to use that as well. You want to look for somebody with integrity, and you want to look for somebody who understands the assets and the investments as well as understanding the taxes. You find a lot of financial people out here that have no clue what's going to happen on the tax return. And if they don't understand the taxes, if taxes are not involved, that's a scary, scary situation.
As we rapidly approach the end of the year, Angela, remind us of some tax tips to keep in mind, especially as it relates to when we should defer income and also why we might want to accelerate our income.
And this is why you got to make sure that your advisor understands the taxes and what happens on that tax return. So I think the first thing to do is to take into account, is your income going to be less this year and more next year, or is it going to be more this year and less next year? Because you've got some decisions and some time to maneuver money and income between now and the end of the year. So if you think your income's more this year and next year it may be less, you may be in a position to where you can defer some of that income to next year, and especially if you're self-employed. So, for example, you might be able to defer a year-end bonus, or if you have a business, you may be able to delay collecting some of the income due to rent or payments or services and postpone the payment of that tax income until next year, or vice versa. If you think your income is going to be less this year, so you might try to collect on those invoices and services. Go ahead and get that bonus if you think it's going to be more next year. So that's the first thing, is to assess whether your income is going to be more this year or less next year. The other thing, we really don't know where the tax rates are going to go from here. Those taxes may have to go up before 2025, so keep that in mind.
Mm-hmm.
So even though your income may be more this year, taxes still may be less.
Now, there are related tax tips when it comes to deductions, aren't there?
Yes. If you think your income is going to be more this year, and you can maybe accelerate gifts to charities, deductible expenses like medical bills that you, rather than, if you're making payments, say, to a hospital, rather than put some off, you might go ahead and make those payments by the end of the year so that those can be deductible. You can go ahead and pay your state income tax, like your estimated tax payment. Same thing with your property taxes if you're not hitting the SALT limit. So there's things that you can do on your itemized deductions as well that can help you this year versus next year. And if you're in the opposite situation where your income may be more next year, you can maybe defer some of those tax payments or hospital bills. So same thing on your Schedule A under your itemized deduction. The charitable contributions are interesting because you could go ahead and accelerate your charitable contributions. And, some of your charitable contributions, if it's cash, it's going to be limited to 60% of your adjusted gross income. There's also a thing called a QCD that you can utilize, which is where you can have your your IRA, whoever the custodian of your IRA, send a charitable check directly to the charity from your IRA. You have to be 70 and a half to do this. So they can send a check directly from the IRA, and that gets deducted off your adjusted gross income. It gets subtracted. You don't have to itemize to get that. So that's something that if you do, you have to tell your tax person, because the only way they'll know it is for you to tell them and show them the QCD letter of how much was taken out of that IRA and sent directly to the charity.
My guest today is Angela Sloan, CEO and founder of Sloan Financial Group. Now, Angela, as people approach their strategic financial planning, they need to keep in mind the tips to maximize their retirement savings. Now, I understand that the average person will live 18 to 20 years in retirement, if not longer. That's a long time to live without that regular paycheck coming in.
That's correct. And it's not unusual for me to see from a married couple, at least one of them is going to live longer than they worked. So you picture yourself having to live a longer number of years than the number of years you worked. Where is that money going to come from? You better be doing some strategic income planning as well. You know, everybody teaches you how to save it. Hey, you just do this payroll deduction every week, whatever. You know how to save, save, save. You have your IRAs, you save, save, save. But then you get to retirement, things take a shift. Now you're in the spending stage. Nobody teaches you how to spend it. The usual answer is a broker will say, well, just tell me how much you need and I'll just have that amount sent to you every month. Well, let me tell you, that don't always work. And I had one just last week whose 401k ran out 4 years ago because that's the method that he was using. He's out of money. He's 12 years older than his wife. And guess what? They bought term insurance. That runs out. He chose the single option on his pension. He's 12 years older than her. And he was just diagnosed with prostate cancer. So when he dies, she's going to take a $4,800 a month pay cut. She is not going to be able to live. All she's going to have is her Social Security check. That's not going to work. And every bit of that could have been avoided had they got proper advice to start with. But they went to somebody, one, who didn't have the qualifications, and two, didn't know what to look for, didn't know what was going to happen on the tax return, did not know how to do the income planning. They did the canned little answer of, I'll just send you however much you need per month, and you'll have plenty to last, don't worry about it. Well, that didn't work, and I see that all the time. The income planning is absolutely essential. It has to be done. And you say, well, when should it be done? Ideally, you need to start that planning about 3 to 5 years before you retire, because I like to do an assessment. This is where you are. This is where you want to go. This is what inflation's going to do between now and the end of your expected life expectancy. This is how much you're going to have to do that. It's never too late, okay? You can always benefit from the planning, but it's best if you start at 3 to 5 years. That's, before you retire. The sooner the better, but even if you're in retirement, you still need to get that planning done. You still need to put your finger on the pulse and say, how am I doing? Am I going to make it? What adjustments do I need to make? The other thing is to look, since we're in such a low tax rate environment, we need to look and see if Roth conversion might be a good option for you. In some cases it is, in some cases it isn't. And that's something that needs to be analyzed per individual. So we're paying less taxes right now than we're ever going to pay. Because I can assure you taxes are going to go up. It's just a matter of when and how much. So doing the Roth conversion and getting the taxes out of the way forever might be the better thing to do.
My guest today is Angela Sloan, CEO and founder of Sloan Financial Group, and this is Weekend Connection on BBN. Angela, as we come to the close of our program today, I thought we would open up this can of worms as far as Social Security is concerned, especially for our ladies in the audience, and I know there are quite a few widows who are listening. I believe it would be helpful to review the various methods and choices that are available to draw their Social Security and not leave money on the table. Are there some things to keep in mind?
Yes, I see money left on the table all the time. And ladies, here's what you need to consider. You might have a husband you're married to now. You might have a dead husband, so maybe you were widowed and then you remarried. If you are not married at age 60, you have choices of which husband to draw from. And I see a lot of money left on the table every day. Prime example, worked for us. She was our receptionist. And we were having a conversation at the front desk. I had read an article about how many women are widowed twice by age 65. And it was a large number. It shocked me. And we started talking and going, well, yeah, so-and-so at church was widowed twice at that age, and I know so-and-so across the street from me, she was widowed twice by that age. And my little receptionist raised her hand. She said, me? And I said, Kathy, you were widowed twice? And she said, yeah. I said, I knew your first husband died. And he died. He was a doctor. He was 38 years old when he died. He died of a heart attack. She had 2 daughters by him. I said, how long were you married to him? Because in that case, you have to be married to him at least 10 years. So she gets a copy of the marriage license. She was married to him 10 years and 2 months. Now, she had worked all these years. He had died at age 38. But she could draw almost twice as much off of him as her own account.
Twice as much.
Almost twice as much.
Mm-hmm.
That's money that would have been left on the table had we not been standing at that front desk having an innocent conversation. So, ladies, don't make assumptions. She assumed it was so long ago. She assumed there couldn't be anything there because I had benefits for the daughters, and, that was so long ago, and he was only 38. She assumed wrong. That would have cost her dearly. So, I do those Social Security analysis. I do ask all the nosy questions to try to get to the bottom of the situation because I see so many situations where money is left on the table, and usually it's a lot of money.
So, Angela, if our listeners would like to get a hold of you or find out more information about what we have discussed today, what is your website?
My website is www.sloanfinancial.net. That's sloanfinancial.net.
sloanfinancial.net.
Or you can call us at 803-222-2892, and we will do everything we can to answer your question and help.
Well, Angela, thank you for spending some time with us today and getting out this important information to our listeners.
My pleasure. Thank you for having me.
Thank you for listening to this feature, a production of BBN, the Bible Broadcasting Network. BBN provides 24-hour Christian programming, great Christian music, and Bible teaching. Listen to BBN by clicking the link in the description.